Hello, my friends. Hey, this is Rob Rosa. I am focused on providing open, truthful, useful, fun, and entertaining information that usually, not all the time, but usually relates to either real estate or helping you improve your life. Now, we have a lot going on this week, and so I wanted to give you a weekly update, right? So first of all, we're going to talk a little bit about the jobless rate and what happened with that. We're also going to talk about the mortgage rates and what happened with that. And lastly, it would not be fair for us to have this discussion without talking about the wonderful world of August 17th. Now, if you don't know about August 17th, then I got to ask you, hey, are you involved in any type of real estate business? Because maybe, my friends, you're not. And that's okay. Hey, Mary, Edison, Lisa, James, thank you so much for joining us. You do not have to be that real estate expert. That's why you have me to be able to help you out every step of the way. All right? So let's talk first of all about, has the Fed waited too long to cut rates? All right? Has the Fed waited too long to cut rates? Well, first of all, as we talk about rates, it's going to be important to show you this, my friends. And what we're mainly talking about is the unemployment rate. So you can see, as we went throughout this past year, between January 23rd, right over, or the 2023, to July 2024, okay? You probably saw that. Well, what ended up happening, and this is a very interesting type of scenario, is the Sahm rule has been triggered. S-A-H-M. Claudia Sahm, or Sahm, some people might say. Okay, so I don't want to say that I exactly know how to say it because I don't, but I know it's the Claudia Sahm, or S-A-H-M, Sahm rule, right? And that rule has been triggered. What do you mean, Rob, that rule has been triggered? Well, whenever the unemployment rate rises more than 0.5% within a year, it's an almost sure sign that we will soon be in, or are already in, a recession. So we're going to talk more about that in a little bit. Also, what's happened this week, and I know you saw it. Hey, Deanna, Bruce, Judy, Judith, thank you so much for joining us. The stock markets got crushed. There's a little bit of a rebound, but really overall, it's been bad news, right? The NASDAQ fell 6% in a day. The global markets followed. The Japanese yen had a massive move higher as carry trades unwound. And the TOPIX, which is TOPIX, Japan's main index, plunged 21%. Right? Plunged 21%. Not only did that plunge Japan's main index, but also the Treasury yields plunged. The yield on the 10-year U.S. Treasury dropped from 4% to 3.8%, with the futures market now putting very high odds on a 50 basis point, which is a 0.5% rate cut on September 18th. And a further 50 basis points in cuts before the year end. So let's see if that's going to happen. Now, some of the good news, right? We have to have some good news. If you know me, I am really all about good news. And I appreciate your likes, your shares. Let's talk about the good news, right? Which is the average mortgage rates fell over this past week. They fell to a low of 6.34%. on August 5th, the Monday after the jobs report. Now, this is much higher than a lot of homeowners currently have. This is still an opportunity, though, for those of you that want to make that move I can tell you it's definitely lower than the average of the last 50 years. Patty, Chester, thank you so much for joining us. And as we're going through some of these items, if you would like to talk more, if you'd like to come on as a guest, a co-host, just come on by and let's get you in here. All right. So that's an opportunity for you. So if we see these mortgage rates continue to lower, that's when the refinancings are going to start to take place, right? The refis. Over the last 2 years, around 6 million nationwide, right, existing homes were purchased with a mortgage. And these were often at rates considerably higher than what was currently available, what's currently available at the time, right now, right? I mean, they were much higher than 6.34%. So these lower mortgage rates could bring some sellers closer to the psychological break-even point where the benefits of moving outweigh the negatives of taking on a higher rate mortgage. All right? So this might be some opportunities that you can take when and if the mortgage rates were to even go any higher. Now, right now, we'll talk a little bit nationwide, and then we'll talk Connecticut because I'm an expert on Connecticut. According to Realtor.com, that's right, you heard me. Hey, Sherry. Hey, Joe, Mikey. According to Realtor.com, Idaho and Tennessee joined Florida and Texas in July 2024 with the most homes for sale, above July 2019 levels. Now, you know what happened in 2020. We don't have to get into that. But now the inventory on those 4 states are above the July 2019 levels. So that's kind of interesting, right? And so, do the interest rates and do the jobs report, does that have a play in it? Well, maybe, right? Maybe. How about rent growth? What's nice, and I like this number, and if you like it, you can put some likes and shares as well, is that rents increased only 0.2%. Only 0.2% month over month in July, and basically look to be flat, because I know that right now rentals are very, very high. I know it's not the landlord's faults, because it doesn't seem to me that, I see these landlords, especially the ones that have single family properties, whether it's a condo or a home or a duplex or a 3-family or a 4-family. I know they're not making tons and tons of money because they have their mortgage to pay. They have their insurance to pay, which has been really, really tough on them, and they have their taxes to pay. Right? So by them keeping these rental rates down as much as possible, hopefully that's going to help many renters. All right, so let's get back to this and talk about this July jobs report. Okay? So again, there's bad news and there's good news. And so, well, what do we mean by that? This is a very much of what we call a tightening cycle, right? A tightening cycle. So when the Fed funds rate is high, everybody is hoping, believe it or not, for bad economic news to slower consumer spending, right? Which ultimately is rising unemployment because it encourages the Fed to begin cutting rates. Everybody wants these lower rates, and lower rates tend to lift asset prices. Lower rates improve mortgage affordability. So you see, the bad news correlates to the good news. But what happens is the Fed usually, right now, I'm not the total expert on it, but they usually keep these rates too high for too long, as far as I'm concerned, the way that I would see what people are doing. And when that recession arrives, right, that recession is almost here, and the Fed rushes to lower the rates, everybody knows this. So when the bad news looks really bad, it makes people worry about an impending recession, right? And a recession means what? Job losses, okay? A plunge in consumer spending. I don't know about you, but when I go to the grocery store, when I see clothing, when I see different things that are out there, I really think to myself, do I really need this? Right? Is this something that I really need? Because it's very expensive, right? And industrial activity, right? We know transportation costs are a lot higher right now. There are, whether we want to agree or not, probably declining company earnings. There was this week a big fall in stock prices, and ultimately, hey Missy, Robert, thank you so much for joining us. Tom, I hate to say this, right? But the bad news is ultimately there was a negative wealth effect. Now, I don't know about you. Let's be totally 100% honest. How do you feel about your wealth right now? Okay. So what we're going to actually do is we're going to take another look at a little chart here. I just want to flip this over, right? Let me flip over this camera and hopefully you can see it easy enough. So right here is the federal funds effective rate. All right, Hannah, Maggie, Kenny, thank you so much for joining us. So you can see the federal funds effective rate notes how a Fed tightening cycle precedes most recessions. So if you look, you can see 1955 and 1965, right? So you could see there in 1960 what happened, okay? There was a U.S. recession. All right. And then the federal funds effective rate went higher, higher, higher. And in 1970, when it was at the point of about 12 and a half, about 10% actually, right? It was almost at 10%. There was a tightening. I'm sorry, this is kind of going in and out a little bit. In 1975, you see that shaded area right there, right? Well, that's when it was about 12.5%. And what happened? Right, there was a recession and they lowered the rates. And then in 1980, right, and 1982, we got through 1990, another recession, a small one. 2001, 2002, and then 2008 and 9 was a doozy, my friend. If we kind of look, 2020, right? The rates were going up just a little bit from 2015 to 2020. And then in 2020, that was uncontrollable, right? But here we are once again, 2024, we're at at this Fed funds rate about 5%, right? And so what many people are forecasting, right, because of the way that the numbers are looking, is another recession if rates are not lowered fast enough. All right. Hey, Yvonne, thank you so much for joining us. Luna, Joel, appreciate you. So let's get back to this whole thing that I had mentioned about the Claudia Sahm or Sahm rule, right? So since this jobs report, there has been an explosion of news articles talking about the likelihood of a recession. And that's why we're talking about it here today. Many of them mention this Sahm rule being triggered and how it indicates that a recession is coming soon or is already here. So that's what it is. Okay, it's named after Claudia Sahm, a respected economist who was on President Obama's Council of Economic Advisors and had worked at the Federal Reserve Board of Governors. She noticed that a rapid change in the unemployment rate was a better predictor of a recession than the level of the employment rate. So again, a rapid change was a better predictor of a recession. Okay? In other words, you could still have a low unemployment rate and still get a recession. Sounds kind of weird, right? So in fact, most recessions begin with a low unemployment rate. So we have another graph that shows the unemployment rate over the last 75 years. And if you're finding this stuff interesting, definitely your shares and your likes are very, very important, right? And also if you can, forward this to someone who you think they might like it, that would be great. So let's show this graph, right, of the unemployment rate over once again the last like 75 years, and we'll see what we find. Okay, I didn't make up these numbers, my friends. This is what they show. All right. Hey, Willie, Chris, thank you so much for joining us. All right. So once again, here's the graph of the unemployment rate. And then these shaded areas, right, the shaded columns, they are the ones that will show a U.S. recession, right, a U.S. recession. So if you kind of look, 1950, right, there was a higher unemployment rate, 1955 or so. It went up really quick, a recession. 1960, give or take, looked a little bit flat to me, but it was kind of a change, up and down, a recession, right? 1970, take a look at that. The unemployment rate rise pretty quick to probably that's about 8.5%. Right? Rise quick to about 8.5%. We have a recession. 1975. 1980 raised from about 5 to 5.5 to 7.5, a recession. Probably 82, 83, a quick change, another recession. Right? 1990, a change in the unemployment rate. 2002, a change in the unemployment rate, and we had a recession. If you remember 2008, let's look at these numbers right here once again. All right, 2008 or 9, we went from about 5% to about 8.5%, had a recession. Then from 2010 to about 2020, steadily decreasing, and the wonderful world of 2020 happened, where we had a huge unemployment rate, and we know what happened because of that. So now they're saying, well, okay, because the unemployment rate is changing so much, right? Is changing so much, well, what's going on? Are we going to have another recession? So if you take a look at it, it has been greater than or almost equal to 0.5%. So if you were to look at that, you would say that we were going to be having a recession. All right. And so there's another number, it's basically a rule of thumb. There's, remember, economics is what they call a social science. That's why I always find it to be kind of interesting. Nothing is certain about economics. Like, you can be a weather person, or you can be get into economics, and you're never like held to it, right? It's just simple and easy, and you can still get paid, and you can be wrong all the time, and I guess that's fine. But many cases, the ones that know how to pick it correctly, those are the winners, and that's what the Claudia Sahm rule is all about. Secondly, because every time you have a recession, you will absolutely have some point where the calculation moves above 0.5. And so if we look at this, that's a leading indicator of a recession, which it looks like we might have. Now, one of the things I've also have in my notes is that, by the way, Claudia Sahm, right, or Sahm, she's still very much alive. And she has a lot of interviews where she does say sometimes that we should ignore her rule depending on the situation, right? And some of those rules were recent. So it really just depends on the scenario. Okay, well, let's talk a little bit about real estate, the fun stuff, keeping it real with real estate. And thank you, Mary Beth, for making us these shirts. So Trish, thank you for joining us, and Brad and Denise, we appreciate it. So listing inventory, how many homes are on the market, Rob? That's what I want to know. You're trying to give me information about real estate. Well, what's going on with inventory? So we're going to take the data from list reports, which they gave me a lot of this information, listreports.com, which is awesome. Thank you so much. And from realtor.com. And what it's showing is that there's a pretty large gap of inventory levels between the Northeast, like Connecticut, and the Midwest regions, which are still very tight. And the mountain regions, right? The South and mountain regions where they are near or above 2020 levels or before 2020. So let's talk a little bit more about that. What are the states with the most active inventory as of July 2024? And like we talked about a little bit earlier, we're talking about Texas, which has a 6.5% change in active inventory. Texas, the highest one from, if we look at the difference between July 2019 to July of 2024. So again, July of 2019 to July of 2024, we have more houses on the market, 6.5% more houses. All right. Idaho, 5.5% more houses. Florida, 4.7% more houses. And I think that probably and Tennessee, 2%. I think that a couple of these states might even, if you take a look at year over year, it's going to even be a lot more than that. Okay. But because everyone wants to or so many people say, well, it's been like almost 5 years since this stuff happened. So where do we stand right now? Well, Texas, Idaho, Florida, Tennessee, from July 2024 back July 2019, they have more houses on the market. But how about this? You might be like, that's no big deal, right? He's only mentioning 4 states. Well, Texas and Florida. How about, hey, Janet, Allison, RJM, Texas and Florida represent 29% of the nationwide active inventory. So almost 30%, right? If you take a third, Florida and Texas represent 29% of the active inventory. And what's that telling you is that a lot of the other states are much different. So here we are. I'm here in Connecticut. Of course, if you need me, I'm ready to help you every step of the way, right? I have all my tools. I have my coffee mug, right? Got to do a little quick plug here for my team over here at Berkshire Hathaway. Okay. I am ready. Now here's what's going on, because I get asked almost daily, hey Rob, how's the market? Well, my experience shows it depends on what market you're talking about, right? Are you talking about the single family market here in the Hartford area? Are you talking about the waterfront homes? Are you talking about commercial leasing? What market are you talking about? Well, let's talk about single family or basic home residential homes here in Connecticut, okay? Because that could include residential homes. When we say this here in Connecticut, it could include, of course, condos, co-ops, single family homes, duplexes, 3 families, 4 units that are all residential. Well, guess what? We are number 1 for the least or the biggest decrease in inventory since July 2019. So if you look, we have in Connecticut the largest decrease in inventory over the last 5 years compared to 5 years ago, July 2019 to July 2024. And that's 74.8%. So we're talking about, and this is according to Realtor.com and list reports, that we have 75% less homes on the market available. I'm telling you, my friends, you put a home on the market that is in accordance with the 4 P's of marketing. It's not every single home. It's not any home, but in accordance with the 4 P's of marketing. Well, guess what? that home's going to sell quick, and you're going to get 5 or 7 or 12 or 22. I had one 2-3 weeks ago. Now it's been almost 3 weeks ago, 27 other offers. And of course my buyer was not happy, but I mean 27 other offers. It's like you have to win the lotto. And so why is it like that, Rob? Right? The 4 P's of marketing. Well, I have my master's degree in marketing, and of course we'll tell you, could it be product, meaning the house, the price, the promotion, the placement? Yes, and I can talk with you another time more about those 4 P's of marketing, but that's what it is. If the home is priced correctly and is promoted correctly, it's in the right location, it's being shown to the right people at the right places, you will get those huge amounts of offers in Connecticut. We're 74.8% less. So if you come to me, you can always come to me. Right? But I don't know what tomorrow brings in. This is not the salesperson baloney. This is the honest to God's truth. The window is open right now, that if you want to get the most money you can possibly get for your property, I'm telling you, my friends, now seems like an absolutely great time if you want to sell within 1, 2, 3, 4 years. Because, recessions do take time. And will the market ultimately even go higher than it is today? I think so. But who knows how many years it can take, right? How many years it can take. So Connecticut, 74.8%. Second in line is New Jersey, 67.1%, right? New Jersey, 67.1%. Illinois, 65.5%, and Vermont 63.1%, right? So Connecticut, New Jersey, Illinois, and Vermont have so many less houses, right? So many less houses on the market. The inventory levels are so much lower compared to 5 years ago, okay? Compared to 5 years ago. Okay. Now we know that inventory levels do not always directly correlate, right, to prices. But it's no coincidence that the biggest price declines are happening in the cities in the South, while the biggest price increases are happening in certain cities like the Northeast. Is that a good thing? Well, TTW, it depends on where you are in real estate. So he, or TTW, I'm sorry, he or she, right? We, because I can't tell. I'm here on the scrolling, right? You're in Illinois, right? And in Illinois, there was a change, she. All right, TTW. So that's what she's asking, right? 65.5% less homes on the market. Well, if you were a seller and you wanted to sell anytime soon in the next, 1, 2, 3, 4 years, it might be telling you, okay, you have less competition. Prices are probably a little bit higher. So now's the time to do it. If you're a buyer, it might mean that it's harder for you right now. But the hardest thing to tell you about that is someone who's a buyer might say, well, I'm just going to wait then. Well, when are you going to wait for? Are you going to be able to time the market, right? Are you going to be able to time the market? Are you going to be able to figure out when the market's going up and when the market's going down and so forth? So that's some of the important things to think about. Do you need money to start getting into real estate? I think you do. Some people say no, but I even teach the real estate pre-licensing class in Connecticut. My class is priced in there with everybody else. We're about $500. Well, technically we're $525, so that's $500. Then you need money, another $80 in order to apply and to take the exam, right? And then you need another $50 or $60, $59 to actually take the exam after you apply. And then you got to start paying your fees. And then you need to, it's just like starting any other business. So do you need money to get into real estate? I think you do. Do you need a lot of money? No. But think about it this way. I mean, this is interesting to me. I love pizza. All right? And so if I wanted to start a pizza place, it's going to cost me all kinds of money to get the space and get the vent and get the ovens and get the dough and get the cheese and get the waiters and the waitresses and all these people. And I know some pizza places that if they make $75,000 or $100,000 of profit, thank you so much for your likes. If they make $100,000 of profit for the year, they're like feeling so happy about it. Well, you can make $100,000 of profit as a real estate agent, and it's going to cost you the fraction of starting a pizza place. Hey, user 808, this guy said I love pizza. That's right. I'm not going to lie to you. Hey, why should I lie? Okay, that's the truth. So, it does it cost you some money? Yes, but the entry fee to kind of get started in a brand new business is pretty darn low. Okay? So, some examples is we said, well, Vermont has 63% less inventory over the last 5 years, but their median price, which is the middle price, right? Not the average exactly, but it's the middle one of all the ones that sold, is up 27%. New Jersey, we said that they have less inventory, 67%, but over the last year, their pricing has been up 19.3%, right? Wisconsin up 14%. So you can tell that when it comes to pricing, right, most of the time it's going to correlate to the inventory, okay? So when it comes to pricing, most of the time it's going to correlate to the inventory. Okay, things are a little bit crazy in Connecticut, I think, right now, because we're here in between New York and Boston. We still have this whole thing: are people working from home or they're not working from home? And what is it that people are looking to do, with their employment issues? Okay, so we talked a little bit about unemployment. We talked about the Sahm rule, which basically shows that there's a pretty good probability of a recession, right? We talked a little bit about the Fed rate cuts. So, let's keep that in mind, all right, that on September 18th, right, that there's a high probability of rate cuts. Will it happen? Who knows? Okay. We also talked about the mortgage, the fixed mortgage rates, right? So let's show you a little bit about what's going on with the fixed mortgage rates. All right. So you can see here, my friends, that currently, and this is just averages, and this is, from Mortgage News Daily. So don't say, well, I talked to my mortgage person and that's not exactly right. We're going with nationwide averages. There's all kinds of different stuff there. But this is the average 30-year fixed rate mortgage. And you could see, as of August 8th this week, the 30-year fixed, 6.63%. 1 year ago, 7.05%. And previous peak before then, which was October, so last October, we were at 8.03%, right? Last October. And the recent low, 6.34%. So, I can tell you, really, whether you want to believe me or not, that if you're paying 6 or 7% for a 30-year fixed mortgage, and you take a look at what's happened over the last 50, 60 years, you are not getting ripped off, my friends. Will we ever get back to the 2.5%, 3% interest rates? Maybe, but I can tell you it's probably pretty much of a long shot. All right, it's probably pretty much of a long shot. All right. So, really lastly, what I also wanted to do was just kind of share some insight with you. And my insight is that things are going to really change come August 17th with real estate. We're going to be talking about how the buyer broker or cooperating broker fee is no longer going to be in the MLS or the multiple listing service, right? How buyers are going to have an opportunity to negotiate, which they always have, right? But it seems as though it's coming to the surface even more. And so our sellers going to have or that more of that opportunity. Even though that opportunity was always there, it might have felt a little bit differently to some people. All right. I truly believe that here in Connecticut, we've been doing it the right way. At least I know that my team and I have. When we sit down with you, you say you might want to sell a property. We're going to talk with you about what we offer, what we do, what the service fee is. Talk with you about what we would possibly offer a buyer broker, and you can make the decision, right? You get to be the one to say what you're willing to offer someone to bring a buyer to your place. And then same thing with a buyer. We would sit down with you, which we still are, and there's been no change in this. I've been doing it this way for 24 years. I want to sit down with you. I want to have, maybe I'm going to have pizza, or I'm going to have some coffee. Right now I have iced coffee in here. I want to sit down with you, have some coffee, get to know you. What are you looking to do? What are your dreams? What kind of house do you and or your family do you want to live in? Right? What's important to you? And then talk about how I may or may not be able to help you. Right? I'm going to be very straightforward with you. Are we a good match? Are we both on the same page? Are you willing to be patient in today's market? Are you going to be prepared and work on getting a pre-approval letter if you need to give a mortgage or not? What are you willing to do? What am I willing to do? And where are we on the same page? And then what my fee is, right? And I can tell you, my friends, it's probably not going to change that much. Let's be honest. No one is going to work for free. Now, if you want to be that person, to have somebody work for free, it's probably not, you're probably not the right person to be out there and interacting with other human beings, because I don't know how much anybody else works for free. So what we're going to find, and I've talked with people that they've already started doing this in other states, is that things really don't change, because when it comes down to it, the buyer and the seller want to work together or want to make the transaction happen, and our job is to help them make it as smooth as possible, as painless as possible, get the best terms for them, look out for them, and make it a great experience. So I think that's where we are really when it comes down to it for August 17th. I definitely wish everybody the best. Of course, if you have any questions about real estate, if you want to discuss the market, or which market, Rob, right? Or you want to discuss your housing needs, all you need to do is let me know. So thank you so much for joining us here today. I hope you enjoyed it. I appreciate your likes. I appreciate your shares. Check me out on the other social media if you'd like to. And this is Rob Rosa. Hopefully your favorite real estate broker. Wishing you a very blessed day, a blessed weekend, my friends. God bless you. And we will talk to you later. Bye.